Have you ever wondered how a company decides if it's a good idea to spend, say, $1 billion on a new factory? Or how an investor figures out what a hot new tech stock is actually worth? They're all trying to answer the exact same question. How do you put a price tag on the future? Well, today we're going to unpack the tool they use to do just that. It's called discounted cash flow, or DCF.
Okay, so here's our game plan. First, we're going to tackle the big question, what's an investment worth? Then we'll get into something called the time value of money. From there, we'll break down the DCF formula itself, piece by piece. Then we'll walk through a real example to see it in action. And finally, we'll talk about why DCF is an incredible tool, but not a crystal ball.
All right, first up. In the consulting world, we live by something called the pyramid principle. It just means you start with the answer first, then you explain how you got there. So let's do exactly that. Let's get right to the heart of what this is all about.
To really get it, let's just frame this whole thing with one simple question. Imagine I promise to give you $100, but you're not going to get it for a whole year. What is that promise really worth to you, right here, right now? Is it $100? Maybe a little less. This isn't just some riddle. It's the exact problem that discounted cash flow was built to solve.
And here's the answer. At its core, discounted cash flow, or DCF, is just a way to take all the money you expect an investment to make over its lifetime and translate all of that future potential into a single number that tells you what it's worth today. Think of it like a bridge between a fuzzy, uncertain future and a hard decision you have to make right now.
So here's the bottom line. You do the math, you get a number, and you compare that number to the price tag of the investment. If the value of all that future cash is higher than what it costs you today, you might just have a winner on your hands. It's basically a big green light telling you that, yeah, this thing is probably going to create more value than it costs.
So we know what DCF is, but let's dig into the why. Why do we have to discount future money at all? Why isn't a dollar next year worth a dollar today? The answer to that is one of the most fundamental ideas in all of finance.
This right here, this is the engine that makes the whole DCF model run. See, a dollar in your pocket right now has potential. It has what we call opportunity cost. You could invest it, earn some interest, whatever. That dollar can start working for you immediately. But a dollar you're promised next year, it's just sitting there. For a whole year, you've lost the chance to earn a return.
And let's put some real numbers on this to make it crystal clear. If you have a dollar today and you invest it at a simple 5% interest rate, in a year, you have $1.05. Simple enough, right? Now, let's flip that. If you're promised a dollar a year from now, its value to you today is only about 95 cents. And why? Because you missed out on earning that nickel. That 5% is the discount we have to apply to future money to figure out what it's worth in the present.
Okay, so we've got the why. Now let's get into the how. And we're going to break down the formula using a classic consulting principle, MEIS. It stands for Mutually Exclusive, Collectively Exhaustive. All that really means is we're going to break it into its two core parts that don't overlap, but together they give us the whole picture. Okay, here it is, the formula. Now, I know it might look a little intense, but trust me, it's just our dollar example on repeat. Let me walk you through it. CF is just the cash flow you expect in a certain year. Year 1, year 2, and so on. The R is that discount rate we just talked about, which accounts for risk and that missed opportunity. So all this formula is doing is taking the cash flow for each year and shrinking it back to what it's worth today. Then you just add up all those smaller present-day values to get your total. That's it.
And this is where that MEIS thinking comes in handy. Because that whole formula, for all its symbols, really just boils down to two key things you, the analyst, have to figure out. Everything else is just arithmetic. Let's break them down. The first, and honestly the hardest part, is forecasting those future cash flows. This is really the art of DCF analysis. It's where deep strategic thinking comes in. You have to make smart, educated guesses about things like market demand, what the competition's going to do, how technology might change, the list goes on. This is where your business judgment is absolutely critical. The second key driver is the discount rate, the R. Now, if forecasting cash flows is the art, picking the discount rate is more of the science. This number has to capture both the time value of money and how risky the investment is. Think about it. A risky biotech startup is going to need a much higher discount rate than a stable, predictable utility company, right? Because the chance of failure is just so much higher.
So how do the pros figure this rate out? Well, big companies usually use something called the weighted average cost of capital, or WACC. It's a fancy term for the blended average return that a company has to pay all of its investors. both its shareholders and its lenders. It basically sets a minimum bar, a hurdle rate for any new project. If a project can't generate a return higher than the WACC, it's not actually creating value for the people who funded the company.
All right, that's enough theory. It's great to talk about, but let's make it real. We've taken the formula apart, so now let's put it back together with a practical example. This is where you'll really see how all these pieces click together to give you a solid number.
So here's our scenario. Imagine a company is thinking about a project that costs $11 million upfront. Their discount rate, their WACC, is 5%. And they expect the project to last 5 years, generating $1 million in cash for the first 2 years, then $4 million for the next 2, and a final $6 million in year 5.
Okay, now we just plug and play. For year 1, we take that $1 million in cash flow and discount it back 1 year at our 5% rate. That gives us about $952,000. For year 2, we take the next $1 million, but we have to discount it back 2 years, so its present value is even lower, around $907,000. See how it's worth less because it's further away? We just keep doing this for every single year of the project.
And after you've done that for all 5 years, you just add them all up. The grand total comes out to just over $13.3 million. Now, what is this number? This is the total present value of every single dollar this project is expected to make in the future. It's the project's intrinsic value, today.
But we're not done just yet. There's one last crucial step. We have to subtract our initial investment, that $11 million. What's left over is the net present value, or NPV, in this case, about $2.3 million. And because that number is positive, it's a signal that this project should earn a return above that 5% hurdle rate. It's the green light we were talking about. This project is expected to create over $2 million in new value for the company.
So we have our answer. The NPV is positive. The project looks good. So what's the so what here? Well, any good analyst will tell you that the number is just the beginning. You have to understand the limits of the tool you're using. DCF is incredibly powerful, for sure, but it is not a crystal ball.
And this really lays out the pros and cons perfectly. On one hand, DCF gives you an objective number to work with. It's also super flexible. You can run different scenarios. What if sales are 10% lower? What if our costs go up? Stress testing your assumptions is key. But its biggest strength is also its biggest weakness. The model is completely, 100% dependent on your assumptions. You've heard the saying, garbage in, garbage out. If your forecasts are wrong, your valuation will be wrong. Period. That's why you should never, ever use DCF alone. It's one tool in a much bigger toolkit.
So there you have it. We've broken down one of the most critical frameworks in finance and strategy. But it's way more than just a formula, right? It's a structured way to think about the future in terms of today. It forces you to be critical about growth, about risk, about opportunity. So I'll just leave you with this question. Now that you have this powerful mental model, how are you going to use it? How would you value the future?